might you go about managing taxes in retirement, and what's the difference between marginal and effective tax rates? Well, here to talk with me about that is Dana Anspach from Sensible Money. Dana, welcome.
Hi, Bob. Glad to be here.
Glad to have you here. And I know this is a topic that we talk about a lot with our readers and our viewers, this notion of how do I create tax efficient income in retirement? Where to begin?
Yeah, well, when we think about efficiency itself, right? We don't want to skirt tax laws, but we do want to pay the least amount legally possible. So, how do you understand the different rates and the different components that impact your taxes in retirement, and then use those so that you can design things at least to pay the least amount that is reasonable and legally possible while still having the cash flow you need. So that's really what we think of when we think of tax efficiency.
So where to begin? How do I achieve that?
I know, right? That's a loaded question. And so you mentioned, marginal rates versus effective rates. So when we think about how the tax code is set up today, there are marginal rates, and those are based on taxable income. So all your income comes in, and not all of it is taxed. Different components in retirement are taxed differently. So that has to be a factor. But ultimately it comes down, there's a what's called adjusted gross income, and then you have deductions. And you have either itemized deductions or standard deductions. But let's take the standard single deduction for 2025 is $15,000, or for a married couple, $30,000. Well, if you have $100,000 of income and you use the standard deduction, net your taxable income is going to be $70,000. And under marginal rates right now, that means some of that income, the first $23,850 of it, if you're married, is going to fall into the 10% marginal rate. And then the next portion of that income, up to $96,950, is going to fall into the 12% marginal rate. Well, if you blend those together, right, you just took the total tax divided by your income, that's going to give you something that is referred to as the effective marginal rate. And the effective marginal rate is a way to look over your lifetime and say, okay, on average, what is my effective rate now? And what might it be later in retirement? And what we'll often see is someone that's done a really good job of saving in tax-deferred 401k accounts. They may have a higher effective marginal rate in the future. And there's all kinds of components that can affect that outside of just what we think of as normal income. And so in a really big picture level, you're projecting all of those factors and you're saying, okay, if I have a higher effective rate later, is there a way that I can shift some of that income to years where that effective rate might be a little bit lower? And that by doing that shifting, that's how you create a more tax efficient stream of retirement income.
Oftentimes people think about taxes in 1 year increments. They don't think about it in the span of their lifetime of tax paying. And sort of what you're suggesting here is they need to have a longer term horizon as they think about the tax implications.
Yeah, a longer term horizon and realizing how complex it is. So there's several different factors in the tax code that impact you in retirement. You have your marginal rates, and then you have what is considered a preferential source of taxable income, qualified dividends and capital gains. Now there's a separate tax schedule that applies to that. And that tax schedule, income that is capital gains and dividend income, stacks on top of your ordinary income. So if you think of it this way, if I am a single person and I had only $30,000 of income and I got a $15,000 deduction, well, I would have $15,000 of taxable income. Now I can have up to $48,350 of income that's qualified dividends and capital gains, a preferred source, and it can be tax-free. So I would have room to realize capital gains and it would be taxed at zero. Now, suddenly, instead of having that $30,000 of income, let's say my income is $70,000. Well, that's going to push those capital gains that I've realized into the next highest rate, which is 15%. So I've used this analogy of like a glass of water, and it has maybe some leaves in the bottom. And as you pour water in, it pushes those leaves up to the top of the glass. And so if you are realizing capital gains and dividends, and you suddenly take more money out of your IRA, or you start Social Security, it can have the impact of pushing this other income up into a higher rate. And so your marginal rate, your rate on the next $1,000 of income can spike. In some cases, it can be double. For example, suddenly it could be over 40% in tax that you're paying on that next $1,000 of income because of the way that these different components connect with one another. The same thing with Social Security. So we've seen cases where someone retired, they may be taking IRA withdrawals, and then they start Social Security, and they're just saying, well, I'm at the 22% marginal rate, so I assume I'll pay, about 20% on my Social Security income. But suddenly they take that Social Security income, and their tax bill is much higher than what they would have expected, because all of a sudden, more of that Social Security can be taxable, or it can push the IRA income into a higher rate, or it can push capital gains income into a higher rate. So all of these things intersect. There's also something called IRMA, the income related monthly adjustment amount, that impacts your Medicare Part B premiums. And then there's the net investment income tax. And so when you start to stack all of these different components of the tax code, you might say, oh, I'm just going to take an extra, $5,000 out of my IRA this year, but almost half of it ends up going to taxes. And you think, what happened? And it's because it's just not as simple as looking at the marginal rates. You have to, yes, as you said, look long term, but you also have to understand it's just not as simple as looking at the tax rates. There's all of these things that intersect.
Yeah. So you mentioned that some of these items push income up into higher brackets. Is there a way to sort of pull income down by chance?
Well, there can be with using that long-term view to plan. So as an example, let's say I have $100,000 in a savings account and $100,000 in an IRA account. Well, I'm going to pay taxes on the interest that my savings account earns. But if I withdraw $10,000 from that savings account, that $10,000 is an extra taxable income. But if I withdraw $10,000 from my IRA, it is taxable income. And so if you were to have CDs that are maturing each year in a non-IRA account, that can prove to be a source of cash flow that isn't impacting your tax return. If you have a brokerage account with stocks or mutual funds in it, and you have to decide each year, well, do I sell some of those stocks and realize capital gains to generate cash that I need to spend, or do I take an IRA distribution? Well, they can have very different tax impacts. So as you were saying, can you pull income out? Well, you can lay out a plan and then every year look at how these factors intersect and say, oh, well, this year it might make more sense for me to use this bucket to get the cash flow I need. And next year, it could make more sense for me to use that bucket. Or maybe I need to combine the two. 5,000 needs to come from here and 5,000 needs to come from here. And so it's not really pulling income out. It's really kind of layering them in a way where the cumulative effect is not pushing too much income, think of it out the top of the glass, into the highest rates.
Yeah. I think you've referred to some of these items as negative taxable income. Maybe it's bunching deductions or net operating losses, carryovers, or large capital loss carryovers.
Well, and that's kind of a different factor. So when we look at people who maybe they've just retired and they can have more deductions than income, that's a situation I call negative taxable income. So you literally can look at a tax return and be like, wow, like they had more income than deductions. They have negative taxable income. That was a wasted opportunity. They could have taken money out of the IRA and paid zero tax or realized capital gains. They actually could have taken money out of the IRA and realized capital gains that year and paid no tax. And so if you were planning ahead and a year like that came along, it could be a huge opportunity. I've seen the same thing with business owners. Maybe they start a business and the first year it has a net operating loss. Maybe it had a big capital investment, different tax reasons that they were able to create this net operating loss. Doesn't mean it's an unsuccessful business. A lot of businesses in their startup phase have net operating losses. Well, those losses get carried forward, but in some cases, those losses can flow through to the owner's tax return, depending on the structure of the entity. That could create an opportunity to convert an IRA to a Roth IRA and pay no tax. So those are some of the areas where I have seen negative taxable income or net operating losses create an opportunity. And if you weren't looking at this before the year is over, and right now while we're filming this, it's near year end. So there is time to look at these things before the year ends to see, are there any planning opportunities that could be essentially a huge windfall for you in your long-term plan.
So I often say that financial planning, retirement income planning is a row and column exercise. And I think what you've sort of described here is sort of proof positive that's what it is. It's really looking at each cell, each column, each row.
Well, yeah, you're talking in spreadsheet terms, which I love spreadsheets. So, yes, it is a row and column exercise, right? It does take a long-term view. Some of the challenges we've seen sometimes with tax preparers, that they're so focused on what saves some money this year that they may not step back and look at the impact over the lifetime of a client and realize that some strategies may cost a little more tax this year, but may save thousands, even hundreds of thousands of dollars of tax over the long run. Other times it's just being aware. I have a friend of mine, he is over the age of 55, just turned 55, got this huge opportunity to buy into a business and leave his corporate job. He works for a big finance firm and he's so excited about it. It's really cool. And so, but the primary source of funds he has to do this is coming from his 401k plan. Well, because he's over 55 and leaving employment after turning 55, he won't have any 10% penalty tax, but he'll still have income tax on those 401k withdrawals. And we're near year end. So one of the things we were talking about is, well, would it make sense if he even used a home equity line of credit on a short-term basis to spread that 401k distribution over 2 tax years? And it would make sense if, for example, he was on the cusp of the 12% rate. And by doing this, he could keep some income from going into the 22% rate. But saving 10% could be worth covering the borrowing costs for just, 5 to 6 weeks, for example, with a home equity line of credit. But there's a case of, someone who needs to look at just the marginal rates and look at what strategies could help him save tax by just spreading this transaction over a few tax years. So, there's all kinds of column and rows types of, math that needs to be done to figure these things out.
So what's the actionable advice for someone that it sounds like it would be difficult to do on your own per se? You might need a trusted, competent advisor to help you through this.
Yeah, you do. You need someone who can project it out. If you're nearing retirement, we think working with an advisor, firms like us that are projecting this out over your lifetime is going to make a lot of sense. There are some cool tools. There's one called Dinky Town. That's a set of calculators. So you could actually go in and plug in your different income sources and plug in if you took it this way versus that way and see what the total tax impact would be. It doesn't allow you to do multiple year projections, but it can be a great way if you're planning just for this year as we're near year end to see what opportunities there may be. You can meet with your tax preparer if you're working with one and say, hey, let's look at this before year end. Is there a chance I'd be in a really low rate where there might be some opportunities? But the key thing is you would have to take action before the year is over to spot these opportunities. And then, I don't know what you would need to do because it would depend on what the opportunity was, but it's definitely worth looking at. The other thing we've found is that if you don't look at it every year, like there has to be a process in place. This is one of the things working with a financial planner does, is it puts this process in place where every year we're going to look at this. Well, we might look at something for 5 years and do a tax projection and go, nope, no opportunities. But all of a sudden in that 6th year, there is one of these opportunities. But if we weren't doing the planning on a regular basis, right, that opportunity would get missed. So it's not something you just do on an ad hoc basis. It's something you build into your calendar to say, okay, every year in the fall, I'm going to do this type of tax planning. Most years, probably there won't be anything really actionable to do, but I'm in the habit of doing it. So that 1 year where I might save myself a substantial amount of money, I'm not going to miss that opportunity.
Well, as I always say, Dana, we've covered a lot of ground. Anything we've missed or just bears reemphasizing?
Oh my gosh. I mean, there's so much in the tax code. I'm sure we've missed a ton of stuff, but just trying to give a high level overview of understanding that just your marginal rates aren't all there is to it, especially when you get to retirement. There are a lot more factors that come into play. So understanding the complexity and the importance of tax planning, I think those are the key things.